After decades of observing the markets, one thing is extremely clear. Major financial crises almost never come as a surprise. They don't appear out of nowhere. They are not random accidents. In reality, they develop slowly. First, small imbalances arise. Then these imbalances grow, and eventually, the entire system begins to show signs of strain. But there is a recurring behavior in the markets. Even when the signs are visible, most investors prefer to ignore them. This happens because markets have a natural tendency to generate overconfidence when everything seems to be working. During periods of economic growth, asset appreciation, and abundant liquidity, the feeling is created that the system is stable. However, apparent stability does not mean structural stability, and today I want to talk precisely about that. I want to talk about the structure of global debt. In recent decades, global economic growth has become increasingly dependent on the expansion of credit. Governments have increased their deficits, companies have expanded their leverage levels, and consumers have begun to finance an ever larger portion of their lives through debt. This model worked for a long time because there was one factor that sustained it all: extremely low interest rates. But when we analyze the data carefully, we realize that we are entering a different phase of the cycle. The cost of money has begun to change. Interest rates are no longer at the same ultra-low level that sustained debt expansion for so many years. And this completely changes the equation. Because in a highly indebted system, small changes in the cost of capital can have enormous consequences. That's why, when we analyze refinancing cycles, debt maturity schedules, and interest rate trajectories, one period begins to stand out very clearly: 2026, not as an exact prediction of crisis, but as a potential point of pressure on the global financial system. Throughout this analysis, I want to explain why this period could become a critical moment for investors, and why understanding the dynamics of debt today may be one of the most important decisions for protecting wealth in the coming years. This is the discussion we need to have now, and it begins with a fundamental question: how exactly did the world become so dependent on debt? To understand why we are approaching a potential tipping point in the global financial system, we first need to go back a few decades and look at how the world entered what I call the era of permanent debt expansion. If we analyze economic data since the 1980s, we see a very clear pattern. Throughout this period, virtually all major economies adopted the same growth model: stimulating economic activity through credit. Governments began operating with recurring fiscal deficits. Instead of balancing revenues and expenses, it became common to finance additional spending through the issuance of government bonds. Companies also adopted a similar strategy. Instead of relying exclusively on retained earnings or equity to grow, many corporations realized they could expand much more rapidly by using debt. At the same time, consumers gained increasingly easy access to credit. Mortgages, financing, credit cards, and personal loans became a normal part of modern economic life. In other words, credit ceased to be merely a financial tool and became one of the main drivers of global economic growth. Now, the important question is, why did this system work for so long? The answer lies in a central factor: the downward trajectory of interest rates over several decades. Since the early 1980s, global interest rates have followed a structural downward trend. This means that with each new economic cycle, the cost of borrowing money has become lower. When interest rates fall, debt becomes easier to sustain. Companies can refinance liabilities by paying less. Consumers can finance homes and goods by paying smaller installments. This process created an extremely favorable environment for the expansion of indebtedness. Whenever an economic slowdown occurred, the solution was relatively simple: reduce interest rates, increase liquidity, and stimulate more credit. This model was reinforced especially after the 2008 financial crisis, when central banks adopted extraordinarily expansionary monetary policies. Near-zero interest rates, massive asset purchase programs, and liquidity injections have come to underpin the global financial system. For years, this created the impression that debt-based growth could continue indefinitely. But there is a structural problem with this model. It depends on one fundamental condition to continue functioning: low or falling interest rates. And when that condition begins to change, the entire system's equilibrium also begins to shift. This is exactly where we are now. After decades of debt expansion sustained by ever lower interest rates, the global financial system has begun to enter a different phase. And this change is more important than most investors realize. For a long time, markets operated on an almost automatic expectation: Whenever the economy faced difficulties, central banks would lower interest rates. This mechanism worked repeatedly over the last 40 years. Was there an economic slowdown? Interest rates fell. Was there market instability? Interest rates fell again. This pattern created an entire generation of investors accustomed to the idea that the cost of money could always be reduced to support the markets. But there is a limit to this model. That limit appears when inflation begins to rise persistently. When inflation enters the scene, central banks no longer have complete freedom to lower interest rates. In fact, they are often forced to do the exact opposite, raise interest rates to contain inflationary pressures, and this is the tipping point that changes the dynamics of the entire financial system, because in an environment of higher interest rates, the cost of capital ceases to be negligible. Companies need to rethink their leverage levels. Governments are facing higher costs to finance deficits. Investors are starting to demand higher returns to lend money. In other words, credit is no longer abundant and cheap. And when this happens in a highly indebted world, the effects can be significant. For years, the expansion of global debt was sustained by the assumption that refinancing would always occur under equal or better conditions. But when interest rates start to rise, this assumption ceases to be valid. Refinancing debt becomes more expensive. And when we're talking about trillions of dollars in global debt, small changes in interest rates can generate enormous increases in the total cost of the system. It is at this point that we begin to observe something important. The financial structure built during the era of cheap money begins to be tested. And this leads us directly to the next critical point of the analysis. Because a large part of global debt is not permanent, it needs to be constantly refinanced. Now we come to one of the most important points for understanding the structural risk of the current financial system: debt refinancing. Many people imagine debt as something static, as if governments and companies simply borrow and carry it indefinitely. But in practice, the system works very differently. Much of the global debt has defined maturities. Government bonds mature in 2, 5, 10, or 30 years. Corporate bonds have specific maturity dates. Mortgages and loans also have renewal periods. This means that a huge portion of the world's debt needs to be constantly renewed or replaced by new issuances. This process is called debt rollover or refinancing, and it works relatively smoothly when interest rates remain low or are falling. In this scenario, those who borrowed money in the past can often refinance by paying the same or even lower interest rates. For decades, that's exactly what happened. But when interest rates rise, the dynamics change completely. Let's imagine a simple example. Suppose a company issued debt a few years ago, paying 2% annual interest. While that debt is in effect, the financing cost is relatively low. Now imagine that this debt matures and needs to be refinanced in an environment where rates are at 6%. Suddenly, the annual cost of that debt triples. For many companies, this means lower margins, less investment capacity, and greater financial risk. Now extend this logic to the entire economic system. Governments, businesses, and financial institutions around the world carry trillions of dollars in obligations that eventually need to be refinanced. If this refinancing occurs in an environment of significantly higher interest rates, the aggregate impact can be enormous. Interest payments increase, fiscal deficits widen. Companies with higher debt burdens face difficulties sustaining their financial structures. That's why economists and experienced investors pay close attention not only to the level of debt, but also to the maturity schedule of that debt. Because the true test of a highly indebted system doesn't happen when the debt is issued. It happens when that debt needs to be refinanced under less favorable conditions. And when we analyze this maturity schedule, we begin to notice something very interesting about the coming years. After understanding how debt refinancing works, the next step is to observe something that few investors follow closely enough: the global debt maturity calendar. This calendar reveals when large volumes of bonds issued by governments and companies will need to be paid or refinanced. And when we analyze this data carefully, an important reality emerges. A huge amount of debt was issued during a very specific period, the years when interest rates were close to zero. This period intensified mainly after the 2008 financial crisis and grew aggressively again during the economic stimulus that followed the pandemic. At that time, the cost of money was extremely low. Governments took advantage of this to issue large amounts of bonds. Companies did the same, often taking advantage of historically low interest rates to increase leverage or finance share buybacks. During that period, This strategy seemed perfectly rational. After all, if money is cheap, it makes sense to use it. But now we've entered a different phase of the cycle. Many of these bonds issued in that ultra-low interest rate environment are beginning to mature throughout this decade. And when we analyze the global debt maturity data, we realize that a particularly important window is concentrated between three specific years: 2025, 2026, and 2027. This period represents a phase of massive refinancing in the global financial system. Governments will need to issue new bonds to replace old debt. Companies will have to renegotiate liabilities that were assumed under much more favorable conditions. And investors will have to decide whether they remain willing to finance this system and under what conditions. This is where market confidence becomes a critical factor, because debt-based systems essentially operate on credibility. As long as investors believe that issuers will be able to honor their obligations, funding continues to flow. But when doubts begin to arise about fiscal sustainability or repayment capacity, financing costs can rise rapidly. And when this increase occurs in an already highly indebted system, the pressure begins to build. That's why many analysts are closely watching the coming years, because we're not just talking about high levels of debt, we're talking about a large volume of this debt reaching renewal point all at once. And this creates one of the most sensitive points in the current financial cycle. When we talk about global debt, many people first think of highly leveraged companies or indebted consumers, but in reality, the most sensitive point of the modern financial system lies elsewhere, in government balance sheets. The governments of major economies today carry levels of debt that, in many cases, are historically high. For decades, fiscal deficits were accumulated with relative ease because the cost of financing these deficits was very low. While interest rates remained low, interest payments on public debt did not represent such a large burden on national budgets. But when the interest rate environment changes, this dynamic begins to transform. Each new bond issued by the government carries a higher cost, and as old debts mature and need to be refinanced, the average cost of public debt begins to rise. This creates a cumulative effect within the budget. Gradually, an increasingly larger share of government revenue is being allocated to paying interest on the debt. This is a critical point because a country's budget has practical limits. If a larger portion of the budget is directed towards debt servicing, less room is left for other essential areas, such as infrastructure investments, social programs, education, or technological innovation. At some point, governments face difficult choices. They can try to reduce public spending, which often encounters political and social resistance. They can raise taxes, which can slow economic activity. Or they can resort to a historically common alternative in periods of high debt, monetizing some of that debt. Monetization means, in simple terms, allowing the financial system, often through the central bank, to absorb a larger share of the debt issued by the government. This strategy can alleviate short-term pressures, but it can also generate other consequences, especially when it involves large-scale monetary expansion. Therefore, when we observe rising interest costs combined with high levels of public debt, we realize that the system is beginning to enter a more delicate zone. It's not just about numbers on balance sheets. This refers to the structural capacity of governments to continue financing their obligations without generating new economic pressures. And this is exactly the type of tension that usually appears in later stages of debt cycles. To fully understand the dynamics of global debt, it is impossible to ignore the role that central banks have come to play in recent decades. In many respects, they have become one of the pillars supporting the functioning of the modern financial system. Following the 2008 financial crisis, several monetary authorities adopted extremely expansionary policies. Among the most important measures were asset purchase programs, often called quantitative easing. These programs basically consisted of central banks acquiring large volumes of public and private securities. The effect of these purchases was direct. By increasing the demand for bonds, the yields on these bonds fell. And when yields fall, the cost of financing for governments and businesses also decreases. For years, this intervention helped keep the system stable. Governments were able to finance larger deficits. Companies were able to issue debt at very low rates, and markets became accustomed to an environment of abundant liquidity. However, the same policy created a kind of structural dependency. As central banks bought more and more assets, the financial system came to rely on this constant presence as a kind of implicit support for the markets. The problem arises when economic conditions begin to demand the opposite movement. If inflation becomes a significant concern, central banks need to reduce monetary stimulus. This means decreasing asset purchases or even selling some of the securities accumulated on their balance sheets. This process is known as monetary normalization. In theory, it's simply a gradual return to more balanced monetary policy conditions, but in practice, making this transition in a highly indebted world is an extremely delicate process. When central banks reduce their share of the bond market, someone needs to step up as the buyer. If investors demand higher yields to absorb this additional supply of debt, interest rates may rise even further. And when interest rates rise in a system that relies heavily on constant refinancing, financial pressure begins to spread throughout the economy. Therefore, the behavior of central banks in the coming years will have a direct impact on the stability of the global debt system. They need to balance two difficult objectives simultaneously: maintaining financial stability and preserving credibility in the fight against inflation. And this balance has historically never been easy to achieve. When a highly indebted financial system begins to face changes in the cost of capital, the effects rarely appear immediately or dramatically. More often than not, the process begins gradually, almost silently. The first signs usually emerge in the bond market. Investors begin to demand slightly higher yields to borrow money. This change may seem small at first, but in fixed income markets, even modest variations in rates can represent significant changes in the value of assets. As yields rise, the price of existing bonds tends to fall. This is a basic mechanism of the fixed income market. But the process doesn't stop there. The second stage typically appears in credit spreads. This term describes the difference between the yields on bonds considered safe, such as sovereign bonds, and the yields required to lend money to riskier companies or issuers. When investors begin to perceive an increase in economic or financial risk, these spreads tend to widen. This means that companies with weaker balance sheets need to pay significantly higher interest rates to raise capital. Over time, this pressure begins to affect entire sectors of the economy. Highly leveraged companies face difficulties refinancing debt. Investors are becoming more selective about where to allocate capital. Projects that depended on cheap financing are no longer viable. Gradually, the flow of capital becomes more selective. This change in behavior can lead to what we call asset repricing. Assets that were previously valued based on abundant liquidity are now being valued based on more stringent financial fundamentals. Historically, this process does not happen uniformly. Some sectors suffer more than others. Companies with solid financial structures and low levels of debt tend to weather these periods with greater stability. On the other hand, businesses that rely heavily on cheap credit to sustain growth may face more difficult adjustments. That's why experienced investors watch the initial movements in fixed income markets so closely, because often bonds are the first to reflect structural changes in the financial system. And when these signals begin to appear, they usually indicate that we are entering a different phase of the economic cycle. When we analyze the history of financial markets, one lesson appears repeatedly. The biggest investment mistakes usually happen when people react too late to structural changes in the economic cycle. During long periods of growth and abundant liquidity, many investors come to believe that current conditions will continue indefinitely. Assets rise, credit is easily accessible, and risk seems increasingly lower. But experienced investors know that financial cycles are never permanent. They watch closely when the environment begins to change, and when signs of pressure on the debt system begin to emerge, the strategic focus tends to shift. Instead of solely pursuing aggressive growth, the priority becomes capital preservation. This type of mindset shift is crucial during times of economic transition.
Historically, periods of debt adjustment and financial tightening tend to favor certain specific characteristics in a portfolio. First, liquidity becomes extremely valuable. Having access to available capital allows one to take advantage of opportunities when markets experience instability.
Second, credit quality is gaining importance. In environments of higher interest rates and more difficult refinancing, companies with solid balance sheets and moderate levels of debt tend to show greater resilience. Third, investors are paying more attention to the risk-return relationship. Assets that previously seemed attractive only for their potential for appreciation are now being analyzed more cautiously. This doesn't mean abandoning growth or innovation investments altogether. It simply means recognizing that, at certain points in the economic cycle, Protecting existing assets can be just as important as seeking new gains. Investors who manage to make this strategic transition ahead of most typically weather periods of volatility with much greater stability. And this brings us to the final point of this analysis. Because when we put together all the elements discussed so far, historical expansion of debt, increased cost of capital, large volumes of refinancing, and fiscal pressures, we begin to understand why the coming years may represent a decisive period for the global financial system. When we look at global financial history, we see a pattern that repeats itself over time. Prolonged periods of credit expansion and increased indebtedness rarely end completely smoothly. At some point, the system needs to go through an adjustment process. This adjustment can occur in several ways. Sometimes it happens slowly, over many years, through moderate economic growth and controlled inflation. On other occasions, the process occurs more quickly, with periods of financial volatility, abrupt changes in credit conditions, and risk reassessment by investors. The central point is that debt cycles always have structural limits. We observed several factors that are becoming increasingly relevant in the global landscape today. We saw how the world spent decades expanding credit in an environment of falling interest rates. We analyzed how the change in the cost of money completely alters the mathematics of debt. We discussed the large volume of bonds that will need to be refinanced throughout this decade. We discussed how governments, businesses, and investors will have to deal with a potentially more restrictive financial environment. When these elements are observed together, a picture emerges that deserves careful attention. It doesn't mean that a specific event will occur on an exact date. Markets are complex systems, and point-in-time forecasts rarely capture all the dynamics involved. But it also doesn't mean that these signals should be ignored. Analyzing historical debt cycles and monetary transition periods, it becomes clear that the most challenging times for investors typically arise after long periods of complacency. This is precisely why preparation becomes so important. Investors who understand structural changes before most tend to react with more calm, discipline, and strategic ability. They understand that protecting capital during periods of uncertainty can be just as crucial as seizing opportunities during periods of expansion. If the current decade does indeed move toward a period of increased pressure on the global debt system, those who study these dynamics in advance will be in a much better position to navigate this scenario. And before we wrap up, if you want to continue following in-depth analyses of economic cycles, global markets, and wealth preservation strategies, subscribe to the channel now, because understanding these structural movements can make all the difference between simply reacting to the markets or being prepared before major changes happen.